Welcome to Financial Revelations, the financial podcast that's going to help you retire successfully and save for the future. You can see us on Twitter at FI Revelations, and if you have questions, you can always email those to Joshua at epsf.com. Joshua at epsf.com. Today we're going to answer a listener question, and then we're going to give you an economic update because some things have changed. And as the data changes, we want to make sure that we're being true to our word to change our posture if we need to. And what I did today is I have a scorecard, and I like to keep things as simple as possible when looking at investing. It's not always easy to keep things simple because of earnings and markets and currencies and all those things, but there are some things that we can do where we can just kind of grade them. And so we're going to give a financial grade to some things today, and I think it'll be helpful. So first off, let's answer the question. I had a listener email in about target date funds. What do I think about target date funds? Now, a target date fund, if you go to Fidelity or Vanguard, they'll have a Fidelity 2025, Fidelity 2030, Fidelity 2035. And the idea behind these funds is that it's 2021 right now, so a 2035 fund would be a little bit less aggressive than a 2040 fund. So be the further the date away, the more investment oriented it would be, the more aggressive it could be. And people want to know what I think about these. Well, I got to be honest with you. It's not that I just don't like them. I despise them. And there's a few reasons for this. Number one, it's kind of a blunt instrument for somebody who works in the money management industry. Our goal isn't to perform like the S&P 500. Our goal should be to beat the S&P 500. So that would be the first thing. Secondly, when somebody comes to us for money management, it's a very personal thing. Everybody's goals and visions for the future and what they want to see achieved in the near term and long term, they're all different. Everybody has different things that they want to do. And so for us to put somebody into a target date fund, I think it would be wasting the person's money to pay us a fee to do that. So I don't like doing that. It's just not nuanced enough. What I want you to do is I want you to build a portfolio. I want you to take a few minutes or pay somebody to assist you to really look at what asset classes you should be in. What are the things that we should be investing in right now? And if it's a mutual fund or an ETF portfolio, that's fine. It doesn't need to be all individual stocks, but I think what it could be, and in my opinion, what it should be, is a very personal type of investment. It should be based around what you want, not what you and 10 million other people want, because nobody is like you, and nobody's going to have the exact same hopes, dreams, goals, and visions as you do. And there's a lot at stake. There is. This is your money we're talking about, and whether it's $100 million or $100, if it's all you got, we got to be true to it. It's all you got. And so we want to make sure that we're investing with your best interest in mind. And I'm not saying that the big companies don't do that. They want you to make money just as much as anybody. I just think that there's a better, more nuanced way to do it. And even if you have to pay somebody to help you, that's okay. Now, you can pay people a couple of different ways. You can pay them a commission, which I don't like, because they have incentive then to trade in your portfolio. You could pay somebody a fee to manage your money, which I do like. And when people do that, you're on the same team as your financial advisor. If you win, they win. When you make more money, they make more money. And the third thing that you could do is you could sit down with somebody and say, can you just design a portfolio for me? And then I'm going to manage it. You're going to manage it yourself. So maybe you pay them $500, maybe once a year, just to look at what you're doing and give you an opinion on it. That's another way to do it, if you have the time. So the stock market in the United States is open from 9:30 to 4 every single day, except for weekends and holidays. Are you working during those times where you have no access to a computer? Would you be able to trade if it made sense to do it? If the answer is no, you cannot trade during the day, then it might make sense to hire somebody. In the long run, you're going to make way more money than if you did it yourself and did it poorly. So just a few thoughts. Stay away, in my opinion, I would stay away from target date funds, even if you're in just a mutual fund and ETF portfolio, which is fine. There's a lot of great mutual funds, a lot of great ETFs. We use a few mutual funds here at the firm that I've used really in my entire career since 1992, coming up on my 30th anniversary. But I don't feel any younger or older. I'm sorry, I don't feel any older than I did when I started. Just a lot smarter with a lot less hair. So if you have questions about target date funds, don't be afraid to call us or email us. Josh is going to put his email address right up here, and we'll also put our Twitter handle up there. We're doing some things on Twitter where we're doing surveys. It's anonymous. I don't know who you are. I just want to see the data. I want to see what people are thinking. So as far as the economic update goes, what I did is I took 4 categories. I want to talk about 4 brief categories today and just give you a grade on them. This is like a pass or fail course. It's either thumbs up or thumbs down. There are degrees of thumbs up, but we're not going to go into that today. Maybe a little bit, but not in depth. But so the economic update and what I call the market guess, because when you see somebody on TV or on a podcast, unless we have a time machine, we don't know what's going to happen next. If you look back a year ago from right now, we were in the midst, the very grips of the pandemic. Nobody predicted that. It really kind of came out of the blue. And so a lot of things, we call them black swan events, unpredictable, unknowable, highly impactful events to either the negative or the positive that can happen in the course of a year. And something usually does happen. It's not generally a pandemic, but things happen. We go to war. Oil goes up in price. A lot of things can happen. So this is as the situation is right now on the ground. First of all, the government continues to pump money into the economy. The House today passed a water infrastructure bill. It's about $700 to $900 billion. It's a lot of money to take lead out of water pipes. That's a good idea. And it's also passed without raising taxes. So I really love that. We didn't raise, there's some user fees that go up, but I've always thought that if you use something, you should pay for it. That's why I love the Ohio Turnpike is the best road, quite possibly in America, because you pay to use it. And they take care of it. If a snowflake falls on Route 480, some of you won't know what that is. You could be in a 2-hour traffic jam, but you could have 5 feet of snow on the ground and the turnpike is clear. So I like user fees. It's a fair way to do something. If you use it, you pay for it. Well, the money that the government is pumping into the economy is very good for the market. So that's a thumbs up. That's going to help markets because money's going to get spent, construction equipment is going to get bought. That is a really positive thing for markets. The second thing that we have is we are still in the midst of reopening. And the reopen trade is still very, very strong. I was just in Greece, and on the way out and the way back, airports were jam-packed. Now, I realize that there are less flights in general right now, so they tend to congregate people at certain times. But TSA cleared more than 2 million people this past Sunday. That's starting to become monotonously regular. That's what we want to see. At the height of air travel before the pandemic, they were doing about 2.5 million people on a Friday and 2.5 million or plus or minus, on Sunday, the day that most people come back. So this is very, very good for travel and leisure stocks. It's great for hotels. It's great for restaurants. This is good for the economy. Second thumbs up. So far, if you're keeping score at home, we have 2 thumbs up. The third thing is, and I have never seen anything like this before in my life. And I've been in the business again since 1992. My degree's in economics and finance. I have a background in finance. The savings balances in banks today, in people's savings and checking accounts, is $2 trillion higher than normal. $2 trillion. What's going to happen is, I heard a phrase, I did not make up this phrase, but I'm going to take it. It's called revenge spending. I know people that since the pandemic started up until recently, they didn't come out of their house. They didn't go to a shopping mall. They didn't go to a store. They didn't go to a restaurant. You can't go to movies. They didn't do anything. They didn't come out. They shopped online. It got delivered, or they did touchless shopping, where you could do this at Walmart, for instance, and some of the other stores around us. You shop online. Somebody comes out, loads it in your car, you drive away. You never had to go into the store. These things are going to change. People are going back to work. Big companies are requiring people to come back to the office. People are traveling. This money is going to get spent, and it's going to get spent in a voracious way. People are going to be eating this up. So the amount of savings that's tied up right now doing nothing is going to get spent. This is extremely good for the economy, and we're going to see that reflected in the quarterly numbers in companies starting in the third quarter, which we're just starting today. Today's July 1st. So that's 3 thumbs up so far on my four categories. The last thing is inflation. Now, we do have inflation. Generally, inflation is not good for most markets. There's some property markets where it is good for, but overall, inflation is not a thing that you want to see at the numbers that we have it right now. Now, I do believe that some of these inflation numbers are going to probably wane a little bit as we reopen, we start to trade more with Canada and Mexico and other countries. The price of lumber and housing and automobiles will probably come down somewhat. However, the fuel inflation that we see right now, I don't see anything that this administration is doing to lower the inflation rate on fuel and energy. And that is a troubling thing. So if I had to give this, I'm going to give this inflation a thumbs down. So we have 3 thumbs up, 1 thumbs down. And the thing about inflation is it could have a very, very powerful impact. If we print a number that is extremely higher than the trend number, I think you're going to see markets get a little bit leery. And I do think that by the end of this year, if these numbers haven't abated somewhat, or at least show signs of, starting to trail down, I think the Fed is going to have to act sooner rather than later. And they don't want to do that because we're still passing an infrastructure bill. They're not going to act. The Fed is not going to raise rates until these big bills are passed, because we're financing them with government debt and it raises the price of them dramatically. And we just don't want to do that. So Chair Powell is not going to raise rates until those bills are passed. After those bills are passed, however they get passed, I think then it's going to be a monthly number where we look at the inflation numbers and we say, are they starting to abate? Is what we thought going to happen happening? But fuel affects everything. And so if fuel is running 5, 6, 7% higher, they're going to have to raise rates. There's just no two ways about it. There's an easy solution. Drill for oil and gas here. And we were doing it. If you take out the pandemic, before the pandemic, the price of fuel was very low. And that's a driver to the economy. That's how you get to 3.9% unemployment. If fuel is expensive, it's really hard to get to those low employment numbers. So that is a thumbs down. So we got 3 thumbs up, 1 thumbs down. I think the markets are going higher. I am a fully invested bear right now. I don't love the markets right now, but we have to stay invested in them because they are going up. And I think they're going to continue to do that probably for the next year. So as things change, we will change. We'll come to you next week. We'll have updated numbers for you. We'll answer more user questions or listener questions. And if you need something, remember, you can always reach out to us, joshua@epsf.com. I love talking to you guys. This is Financial Revelations, and I am David Safransky.